In his speech at Jackson Hole earlier this morning, U.S. Federal Reserve Chair Jerome Powell signaled the U.S. central bank is prepared to raise interest rates further if needed and keep borrowing costs high until inflation is on a convincing path toward the Fed's 2% target. Let's bring in our next guest for some analysis. We've got Blake Gwinn, head of U.S. rate strategy for RBC Capital Markets. Blake, you said in your note to clients about what you're expecting, you said not much. Did he deliver on that front?
It's weird. I think looking at the market reaction, there's clearly some interpretation out there that this was hawkish. I've read the speech twice now. I'm just really not coming away with that same impression. I think coming into the speech, a lot of people were expecting something hawkish. There's been a lot of talk about R-star, the longer term neutral rate, that he may discuss that and kind of push expectations for that higher. That was, I think, a big basis for the hawkish expectations. Also, you could argue that since the July meeting, the data has been pretty positive. We've gotten very positive consumption data. We've gotten good housing data. So I think there was already kind of a setup there where he could have come into this, acknowledged those things, acknowledged being a little worried about a reacceleration. He didn't say anything about R-star, so that was kind of off the table. I think on the actual data, he gave a little bit of acknowledgement to housing markets picking back up, mentioned not cooling as expected. But I think there was plenty there on the dovish side as well. He's talked about easing wage pressures and having confidence that these lagged effects are still going to show up. So I thought it was very balanced. This is one of those times where I'm not really seeing it the way the markets are necessarily.
I guess we were trying to figure out if this was going to be as devastating as it was last year. So maybe the markets were sort of primed for that, but we had been kind of weakening going into it. Nevertheless, to your point, the market pricing about September is unchanged. Only 20% chance of a rate hike, but November went up. It shouldn't be a surprise, though, that we get another rate hike because according to the June forecasts, I believe, that's what was signaled, 2 more rate hikes.
Yeah, November went up very slightly. It's our call that the July hike was actually the last one. I stick with that call. But I think the fact that, whether or not we get one by year end at this point is very much a toss up. My view is that they're really going to push this as long as possible, to just keep this kind of hike dangling over the market's head, meaning, they come out in September, reaffirm the dots that say there's another hike coming, but don't actually hike. And then, by the time we get to November, let's see where the data is. It's still quite a ways away. But I think they just keep pushing it off long enough that they don't actually have to deliver. I'm still there, but it wouldn't take much improvement in the data to get to that second hike. I think what's really more the hawkish read of markets probably around this, because as you said, the odds of that October-November hike did go up a little bit. But I think what this is really more about is how long the Fed is going to hold at that neutral rate. I think markets are starting to believe a little bit more that the Fed is going to be on hold well into 2024. So I think some of the sell-off in rates, particularly at the front end, is really more about that idea of holding longer rather than it is hiking in September or November.
Do you believe that?
Like I said, I came away from that with a much more mixed view. I thought this was a very balanced speech. You mentioned 2022, how that was a big shock. The setup into these speeches was very different. I think coming into 2022, if you remember, financial conditions were easing in a way that I think was making the Fed very uncomfortable. And Powell reportedly, kind of tore up his speech last minute and penned something that came out as very hawkish to fight back against that. I think the Fed's very happy with where markets are at right now. They've got that optionality of another hike. We've kind of priced out a lot, over the last, 3 or 4 weeks, we've priced out a lot of those cuts that are priced for 2024. So I think they're pretty comfortable with where, market pricing is, where market expectations for the Fed are. So I didn't really think Powell would come into this with a big axe to grind or think that, I really have to push back against market expectations in either direction. And I don't think he did that.
He did say a persistent above trend growth could warrant additional tightening. Again, no surprise. Do you care about the Atlanta Fed GDP now? I mean, that number that they're calling for 6% growth, I put it to some strategists. They say it's not a real number. I don't know, that it is a Fed number.
Yeah. So I think the GDP now forecast is very useful if you use it the right way. The Atlanta Fed is very quick to say that this is not a subjective forecast. This isn't a bunch of economists saying this is what we think GDP is going to do. It's merely tracking where the subcomponent data is coming in over the quarter. So, the analogy that I've kind of used to people is, sometimes a baseball player will come out at the very beginning of the season and hit 3 or 4 home runs in the first few weeks of the season. you could say, oh, they're on pace to hit 150 home runs for the rest of the season. Nobody thinks they're going to hit 150 home runs and, essentially double home run records. But it's just saying they're coming out to a very hot start. And I think that's what the GDP now is kind of telling you. It's just saying the data we've gotten so far this quarter has been very good. It's been very hot. And I think using the GDP now that way is really more as kind of a direction indicator of where the subcomponent data is heading. It's much more useful than taking that number that it's suggesting and thinking that that's actually going to be the GDP for the quarter.
Well,
but to your point, it is very high, so it's a very positive. We've had very positive data to start the quarter.
One number that does appear very fixed is 2%, the inflation target, despite rumblings that they should move off of that and get to 3%. Could that be the disappointment? Is that he said, no, that's going to be our target. We're sticking with it.
I think that got worked in a little bit ahead of the meeting. I think before the Jackson Hole speech, I think there was a bit of an attempt before the speech to really kind of latch on to, hey, this is going to be a big exciting theme. At first, it was our star. Then people like myself started kind of pushing back against that and saying, okay, slow down. I don't think there's going to be this big R-star messaging. I think the next phase of that was a lot of talk about the inflation target. Now, to be fair, that's been going on for some time, but I think it was heating up in the days into Jackson Hole because people are looking for something, looking for some kind of big theme to come out of this. I think at some point the Fed and the market will have a discussion about whether 2% is the right level. Whether even having a level is the right way to think about it, or whether other types of targeting, whether it's NGDP or, moving to a range or something like that, some other type of framework. I think there will be a conversation about that, but that's something that's not going to happen until 2025. They're never going to switch that midstream because they don't even want to introduce the idea that they're softening on that inflation target right now. They just can't afford for markets to start thinking that they're backing down on the inflation target. So that's a conversation that's going to have to come, after this part of the cycle. After we're really past this part of the cycle. And, we have scheduled another revamp of the policy framework in 2025. And I think that's a much more appropriate time for that conversation. And I don't think the Fed will address it before then.
All right, Blake.